Pardon me, the drink?
Yeah.
Help yourself. There's also a water cooler there.
I'm gonna call Eric's computer. Can you answer it? Okay, never mind.
Being recorded.
All's being recorded. Okay. I think we're getting some feedback. Okay, we want them with the next thing is industrial production. Once again, these are economic indicators. These are various economic indicators, some of the big ones. We were last talking about what the effect of these indicators would be on stock prices and bond prices. A positive meant that the gross domestic product, we said that positive means that if gross domestic product is up, we'd expect, all else equal, we'd expect stocks to go up. Gross domestic product is up, we expect bond prices to go down. So we're through all these things. We're at industrial production. Who wants to take a swing? Why would Jane? Andrew says that if industrial production is up, stock prices would be up. Why do you think that's the case? All else equal, most of the time.
Is it just like making things?
Mm-hmm. Industrial production is factory output. Let's look at it as factory output.
Well, like if it's okay. Just because like if they're making a lot of products and the company and the company's doing well, so they have money to do it.
Yeah, if they're making a lot of stuff, it means they think they're going to have a lot of sales, which means they think that they're going to have better earnings. And once again, this is not the level of industrial production, but where does industrial production come out relative to expectations? Any market is priced for what the market expects. So if industrial production is up more than the market thought, you'd expect stock prices to go up because that means that companies have good sales and they're looking to produce more. So chances are their earnings are going to go up. But it's versus expectations. It isn't just industrial production being up. It's that industrial production is up more than expected. Elizabeth, why do you think that bond prices will go down if industrial production was up more than expected? Stronger economy, greater demand for money, more of a demand for money means interest rates go up. Also, stronger economy could lead to more inflation. Higher inflation means bond prices down. And final thing would be substitution. That if companies are doing well and making more money, well, maybe they'll sell bonds and buy stocks. Okay. Housing price index. Charlie, why? the housing price index goes up more than expected. In other words, they thought housing prices were going to be down 19% year over year, but they're only down 18% year over year. Okay? Housing prices are up relative to expectations. Why would you think that would make?
Because that means the market's doing good. And
Meaning the economy's doing good?
yeah.
Yeah.
A house is a family's biggest asset generally. It makes up like the greatest. Like if you were to look at, your family, what they own, all the money they have, and all the various goods they own, like cars and a TV. The biggest single thing that they own that's the most valuable is their house.
Not these families, but for the average American.
For the average American. And so, in general, if house prices are going up, people are going to feel more wealthy because here's their biggest asset, and it's gone up in value.
Okay.
And if people feel wealthy, they're more likely to buy things.
Hey, Catherine, why would the housing price index be stronger than expected? Look for it to be down 20, it's only down 18. Why would you expect bond prices to go down on that?
Because of like inflation and interest rates.
Because what's that?
Inflation and interest rates.
Meaning that you'd have more inflation or less deflation than you thought before, or not have an upward. I'll go along with that. Okay. Retail sales. Abby, why, if expecting retail sales to be down 0.5%, instead they come out at even? Retail sales are stronger than expectations. Why would you expect stock prices and bond prices, stock prices to go up and bond prices to go down?
Because when the retail sales are selling,
Pardon me, I
when
didn't.
it's selling at higher than it was actually expected, people are going to buy into it more, and the stores are going to keep selling at the same prices that are being sold, that people are buying it.
Right. Economy stronger than people thought, meaning that earnings for individual companies are going to be stronger than people thought. Okay. Okay. Retail sales, same. Stronger economy. Retail sales stronger than expected means the economy is stronger than expected. Means that there's more of a demand for money. It means that whatever inflation was or deflation was, you'd expect that prices were going to rise more or drop less than you previously thought. That's why bond prices will go down. The ISM manufacturing index is an index of the strength of the manufacturing sector. And once again, it's another. If the manufacturing index comes out stronger than expected, same thing as industrial production. It means people are producing more than we thought they were going to produce. Means they must have an idea that they're going to go sell those goods someplace, or maybe they sold them before they manufactured them. And so, stronger economy leads to higher earnings, leads to higher stock prices. But that same stronger economy tends to create more of a demand for money, an increase of a chance in inflation, and also substitution effect that people would be more inclined to sell some bonds and buy some stocks, and that causes a depressive effect on bonds. Okay. Now we'll get into material that you read. Okay. Hold on. This isn't the first thing we did, is it?
It's not the first thing we did.
Review the terms. Okay. Wait. Okay, we've gone over some of this stuff, but we're going to go over it again. One, because it's real important, as you watch Cudlow and Company and read Barron's over from now till the end of the year, you're going to see these terms. We've discussed them, but we're going to discuss them again. And also, these terms were discussed in the chapters 5, 7, and 11 of the Malchio book. Okay. Dividend yield. That's the dividends per share divided by the share price. You can look at that as something that's analogous to what you earn on a bank deposit. You can take $10,000 and you can put it in the bank, and you can earn probably 1.5% now in a savings account, right?
I get 3%.
Well, that's because you're dealing with some.
No, HSBC.
Bank. What?
HSBC.
Okay.
We can discuss it after class.
Yeah. You can take your money and deposit it in a savings account and earn somewhere between 1% and 3%. Or you can take that money and buy the S&P 500, where the dividend yield is 2.5%. So it's dividends per share divided by price per share. That's the return that you will earn every year if the dividends stay the same. If the dividends were to fall, which they do sometimes for individual companies, it happens all the time. But for the market as a whole, dividends tend not to fall too often. They only fall during really bad economic times. In fact, in the history of this country, dividends have a very strong bias towards going up. And so, although the dividend yield of the S&P 500, although the dividend per share could go down and your return could drop from 2.5 to a lower rate based on the price that you bought the S&P at, generally, you got a pretty darn good chance that that dividend rate is going to go up and you're going to earn more and more on your money. Earnings yield. The dividends, as you remember, is the amount that a company, as a shareholder, you have the right to your percentage share of the earnings of that company. The dividend is the cash that they actually send you once a quarter or once a year. The earnings are the total earnings that's associated with each share. Earnings yield is simply the earnings per share divided by the share price. This is interesting for a couple of reasons. I should say, we've discussed this before, but some people say, well, the only thing that matters is the dividend, because that's the only money that I get. Well, what if they take those earnings and they buy the share price back? Well, then they reduce the number of shares from 2 million shares to 1 million shares. Well, if the earnings were $3 a share when there were 2 million shares outstanding, and they bought 1 million shares back, well, now your share of the earnings would be what? $6 a share. Okay? So there's an argument that there's a great argument that dividends are important. Dividends per share are important, but earnings per share are also important. Now, the Federal Reserve Bank uses this ratio of earnings yield to have a very simple model to decide whether stocks are high or low. And their model, simply put, is when the earnings yield is greater than the yield on 10-year treasuries, then stocks are cheap. And when the earnings yield is less than the yield on 10-year treasuries, then stocks are rich. Cheap means too low, and rich means too high. What are they right now? The S&P is about 1230. The earnings are the estimated earnings at Bloomberg are $76 a share, and so that gives a earnings yield on the S&P 500 of about 6.2%. It's in there. I just checked it.
Okay.
Hit BBT, please. Tell me what the yield on the 10-year note is.
388.
Okay. The yield right now, the yield on the 10-year government is 388. The yield on the stock market, the yield on the S&P 500 is 6.2%. That is saying, according to the Fed's model, that stocks right now are incredibly cheap. I mean, they're yielding 232 basis points higher than the yields on governments. And there have been plenty of times when the yields on stocks, the earnings yield, has been less than the yield on 10-year governments. Now, okay, we'll get to this in a second. Okay, let's go to our third definition, PE ratio. You see that all the time. Now, PE ratio is just the inverse of the earnings yield. Earnings yield is earnings per share over share price. The PE ratio is the inverse, the share price over earnings per share. So it's obviously they're perfectly correlated. They're inversely correlated, and some people like the Fed looks at the earnings yield versus governments to say whether stocks are rich or cheap, and some people look at the PE ratio. Obviously, all else being equal, if the government yields stay the same, when the earnings yield goes higher, stocks get. If everything stays the same and the earnings yield goes higher, does that make stocks cheaper or richer? Elizabeth. Everything stays the same and the earnings yield goes higher. Does that make stocks cheaper, a better buy, or a better sale?
Cheaper.
Makes it cheaper. Right. Okay. So the PE is the inverse of that. All else equal, when the PE drops, when the earnings yield goes higher, it means stocks are cheaper. When the earnings yield goes lower, it means stocks are richer. With the PE ratio, it's the opposite of that. When the PE, all else equal, when the PE ratio goes down, it means that stocks are cheaper. When the PE ratio goes up, it means they're richer. Now, I said all else equal. You obviously have to compare that to interest rates and forecasts of earnings, et cetera, et cetera. Okay, question. Are stocks an automatic low when PEs are low? And that same thing is saying when PEs are low or when earnings yields are high relative to 10-year governments. So adjusted for interest rates, when the earnings yields are higher than 10-year yields, which they are now by a large margin, and when PEs, saying the same thing, the PEs are low relative to interest rates, is it an automatic that you got to buy stocks? Catherine.
Isn't that what we were talking about? How like if you're about to retire, maybe you don't want to buy them because they could just go lower, and then so it depends on like how long you intend to keep them.
Okay, you got life cycle issues. You have an asset that's stocks, and you got to match it against a reason for owning stocks. One thing would be retirement. That's a great reason. That's a great reason. No matter how stocks cheap are, no matter how cheap stocks are, as you get closer to retirement or into retirement, maybe you don't want to own as many stocks, so you shouldn't buy more of them when they go down. Good point. Can somebody else come up with another? Charlie.
Wouldn't you buy if it's cheap?
Yeah, you'd buy when it was cheap. Okay, I'll throw a couple of scenarios out. Let's say that right now stocks are cheap by the traditional Fed measure, but couldn't it also be that the stock market is telling us that the growth rate for earnings is not as high as we thought it was? And in fact, maybe the stock market is telling us that earnings aren't even going to grow for the stock market as a whole. Maybe earnings are going to go down. And although, earnings for a successful economy that is not expected to lose a war, be invaded, and have everything taken away from us, that's not going to happen to us. But you talk about war, it's a completely different issue. Someone come in and take your stocks. But what the market could be telling us is that it's forecasting not only that the growth rate in earnings, not only that the growth rate is going to come down, but that earnings aren't going to grow at all. And in fact, they're going to go down. and maybe they're going to go down a lot because housing prices are going to keep going down. Banks are going to go bankrupt. Consumer confidence is going to drop. Massive numbers of people are going to go bankrupt, and they're going to stop spending money. So the earnings of every company in the United States is not going to rise, but it's going to go down. So that the earnings yield that we think we have, looking at the anticipated $76 per share that's expected to be earned by the S&P 500 companies, divided by the price of $12.30, that they're really not going to earn that $76. That they're only going to earn $50. Okay, so that's one thing. Another thing. Okay, so once again, to go back to remember our present discounted value, we have the earnings, we have the growth of earnings, and then we have the interest rate that those things are discounted by. Stocks trading cheap like they are right now, it could be they're just cheap and this is a buy of a lifetime, or it could be the market is telling us that earnings are going to go down, or the market is telling us that this is very volatile and the proper credit spread to add into the risk-free rate is higher. So the proper rate to discount future earnings by is not just the government rate plus 1%. You think we should call that up again?
Sure.
Just call back here's our stock valuation. We have the risk-free rate of 4%, pretty close to what it is. Maybe the risk premium should be 10%. Maybe the earnings growth rate isn't 6%. Maybe it's down to 4% over the long run. And finally, maybe initial earnings are going down this year from 228 to 178. That's saying, geez, theoretical value we had it at $40.12 before. Stock's only worth $18.51, and so our model for valuing stocks, what the rule of thumb measure about the value of stocks. The rule of thumb measure is that when earnings yields on stocks, the stock market as a whole, when the earnings yield on the S&P 500 is substantially cheaper than 10-year government bonds, means bonds. The rule of thumb is that you should be buying stocks. But what the stock market could be telling you is that the growth rate's going down, earnings are going down, it's more volatile, the risk premium's going up, so these things are worth less. Okay, so no, it isn't an automatic. On to the next one. Efficient market hypothesis. You guys read about that. Who wants to tell me what the weak form of the efficient market hypothesis is? Jeffrey.
The weak form of the efficient market hypothesis says that you can't predict future stock prices based on past performances.
Right. Past price data.
Past price
Right. Right. Okay. Is there anybody that wants to take and that's correct. Does anybody want to take a swing at what is the semi-strong form of the efficient market hypothesis? Catherine.
Can't depend on
Published. You can't depend on public information. You can't predict future stock prices with public information, either past price data or any available news. Okay, and that's correct. And the strong form, and the other way of stating that is the price of any security. The other way of what Catherine just said is that the price of any security reflects all known information about that security. So you can't figure out where a stock is going by any amount of research. It is where it is, and the millions of investors, really smart people all over the world, have looked through all this information, and they've decided the value of the stock is right here. And although you could be lucky buying one stock or another that outperforms the market over time, you are you're not going to get superior returns by studying any information. Okay. Okay. I'll catch you later. Okay.
Bye, everyone.
I think we're gonna go next Monday. We're aiming for Monday. Okay.
I'm not gonna write it down.
Weak form is past performance, right?
Pardon me?
Past performance.
Weak form is past performance. Past prices are not efficient, are not predictors of future performance.
That's a refutation of technical analysis. Do you guys remember what technical analysis is from the reading?
Simple technical analysis. Simple technical analysis is just looking at a chart and saying, well, this
Right.
chart formation, this stock has gone up and down like the oscillator on an oscilloscope, and so when it's high, you sell it, and when it's low, you buy it.
So weak form saying charting doesn't work.
Yeah.
It says charting doesn't work, but you can take that to that same argument that past price performance does not, past price data does not predict the future behavior of stocks. It can go well beyond charts. It can go on to sophisticated mathematical models, which apply all sorts of higher order math. That's what the weak form says. I'm not saying whether it's right or not, but that's what the weak form
Is that
says.
just his opinion? Kinda
Well,
confused. There's a lot of opinions.
That is Burt Malkiel's. Opinion. That's a question that's been created many a master's thesis, what can I say about that? I think I can say definitively, reviewing all the literature, that is true 99.999% of the time. There seems to be a few people that have used past price data to predict future prices. And I was going to get to this later, but there's very few. One of the organizations that has done it is an outfit called. I'll get to that later. In the world, a handful, and they're pretty brilliant people using really sophisticated math. They're not doing it just with charting software from Bloomberg. Okay, the strong form is interesting. The strong form of the efficient market hypothesis. Want me to take this or? Okay, the strong form of the efficient market hypothesis says there is no information, known or unknown, public or private, which can help you, which can allow you to beat the market return over time. In other words, even if you had inside information, even if you knew private information about a company, what their earnings were going to be, what discoveries they just made, what patents they're about to file for, what contracts they had just signed. Even if you knew every bit of private information about a company, you still, knowing all that public and non-public information, you still would not be able to beat you still would not be able to fashion an investing plan that would do better than just being invested in a market index. Okay, those are the three forms. Okay. Is the market efficient? Okay, well, if you look at the performance of mutual funds, in any one year, there's all sorts of mutual funds. Remember what we discussed what mutual funds are? Mutual funds are entities that buy portfolios of stocks or bonds or other instruments. The performance of mutual funds, every year there are some mutual funds that beat the S&P 500 or a suitable benchmark index for that group of mutual funds. When you look at 5 year periods, there's less. 10-year periods even less. The number of mutual funds that beat the market over time are very small. Classic example, there's a guy, Bill Miller, who ran the Legg Mason Value Trust. And he was a famous investment guru because he had the record for the most consecutive years of beating the S&P 500. He beat the S&P 500 for 14 years. No one had beat the S&P 500 for as many years. And last year he didn't beat it. And the years he was beating it by, well, some years he beat it by 10%. And some years he beat it by 5%. But there were a lot of years he beat it by 0.2% or 0.5%. And last year he underperformed the S&P by 30%. And this year he's underperformed by 30%. Or last year it was like 15%. And this year he is down 20%. So he has underperformed the S&P 500 by so much in the last year and a half that he's given up all of the gains that he beat the S&P by in the 14 prior years. And that is that's an anecdote. That's an anecdote, but this is a fact. Very few mutual funds beat the S&P 500 or whatever their proper comparing index is over a long time. Now, another thing, in looking at, you say, well, there's some people that do. So what you have to do is find out what are the funds that do beat the S&P 500 and buy those, or buy the stocks that they're buying, and then you'll beat the market. Well, you got to consider in looking at this, you got to consider the survivorship bias, and that is that stocks, mutual funds that do well, that beat the S&P 500, they get more money over time. Mutual funds that do really badly and really underperform the S&P 500. Some mutual fund is formed and the S&P goes up at 10% a year, and there's somebody targeting the S&P and they're only going up at 4% a year, then nobody's going to put any money into them, and they'll eventually fold that fund. They'll liquidate it, or they'll fold that fund into another fund. So it's even worse. The performance of mutual funds beating the S&P 500 is even worse than you think, because there's not that many that have beat it, and the proper number to compare that to isn't the number of total mutual funds that exist right now, but the number of total mutual funds that have ever existed. One way to look at it is what's called the survivorship bias. Let's say we put 1,000 mutual fund managers in a room, okay? And you say, okay, it really doesn't matter whether they are good at picking stocks or not. We're going to determine whether a winner or loser just by the flip of a coin. So give all 1,000 of them a coin, and they flip it. And the ones that get heads, well, they beat the market and they prosper. And the ones that get tails, they're out of the business and they go out the door. So you're down to 500. And then 500 more mutual funds come in. And everybody flips a coin, heads and tails. Well, of the 500 that were there from the prior year, you can expect that 500 of those guys are going to flip heads, and 500 are going to flip tails. So the 500 that got the 250, excuse me, if the original 5 got 1,000, if the first year you got 500, and then those 500 flip a coin, heads or tails, and the ones that get heads stay, and the ones that get tails go out. Well, and you keep doing that, and you don't go down to 250, 125, 62, 30, 16. You don't go down to less and less because more people come into the mutual fund business. But even if it's a 50-50 coin flip, if you had enough people, if you had a large enough number to start off with, the odds are overwhelming that at least one person would be able to beat the S&P 500 over 14 years, right? And that's what we saw. And what we're saying is what I'm trying to say is, of the people that have beaten the S&P 500 of the mutual fund managers that have beaten it, is it that they're really good and can continue to beat it? Are they effectively just in a random game and they just happen to be the lucky person? Was Bill Miller the lucky person that just happened to, get heads 14 straight years? Data mining. Some people will say, "Oh, I found an investment strategy that beats the S&P 500 over time." How do they get it? Well, it's one thing. They do what's called back testing. They say, "Well, I've looked at this strategy going back in time, and if you would follow this particular strategy, you would have beaten the S&P 500 by 2% or 5% a year." Say, well, that's great. You go back in time and you look to see what works, and then you do that in the future. So you discover a new investment strategy, and you find that strategy by testing the theory against past data. Well, just because you come up with a mathematical model which worked at getting superior returns in the past doesn't mean it's going to work in the future. Classic example is this. Since the Super Bowl first happened back in 1966 or 67, I think it was, if every year that the Super Bowl winner was an old NFC team, if you bought the stock market, and then in every year that the Super Bowl was won by an old AFC team, you sold the stock market, you would have become incredibly wealthy. Because overwhelmingly, the years that the NFC team wins, the stock market goes up. And the years that the old AFC teams win, the stock market goes down. It's important to look at old AFL versus old NFL. Because the Pittsburgh Steelers, for instance, are and for a while it was NFL, it was NFC against AFC. But then it turned out that the stock market wound up going up in years that the Pittsburgh Steelers won and the Baltimore Colts won. But then the people that determined this theory said, well, that's clear. Even though the Pittsburgh Steelers and the Baltimore Colts are AFC teams, they're old NFL teams. So when the old NFL teams win, stocks go up, and when the old AFL teams win, stocks go down. And it worked. It was fail-safe. So who want to bet their life on or half their net worth that's going to work in the future? Would anybody? It's worked really well. It hasn't worked a couple of times, but if you would bet 10% of your net worth leveraged every year on that, you'd be a wealthy guy today. Well, that's the thing about data mining. You can, just because you find something in the data, just because you find something in past price data that gives you a superior investment strategy, doesn't mean it's going to work in the future. That'd be foolish to, make a huge bet based on the NFL or the AFL. Although I did do it once, and lost. Darn. Okay. Good news travels fast. If somebody does come up with something that beats the market, let's say we found something this summer. We didn't get around to it, but let's say we found it. Well, hey, we're going to make a lot of money. The first thing we do is we take a vow here that nobody would tell anybody else, because we found out a way to beat the market. Okay, and we're just gonna invest our own money. But it's just us people right here at the table. But I got more money than the rest of you, and you guys are going to start to feel bad because I got a lot to invest and you just have a little to invest. And so one of you says, I don't think this is fair that Gary is making more money. We're all getting the same percentage return, but you just got a few thousand to invest, and I got more than that. So you say, well, what it takes is one of you to say, well, I'm going to go to my friend who's a wealthy person, and I'm going to take some of their money and use this strategy. And I'm going to get paid a portion of the money that I make for them. And then, boom. So the word gets out, and good news travels fast. So one of you tells a friend, and that friend tells somebody else, and this stuff goes like wildfire. And even if you do find something that beats the market, once it gets out in the general domain, then it's going to be a self-defeating. It's going to be a self-limiting strategy. Because once everybody starts to do something, then if your strategy was to like Burt Malkiel talked about, to buy stocks at the end of the year and sell stocks in January because they go down in late December and they go up in January. Well, if it turns out that works and somebody writes an article about it, then people will start, instead of waiting for December 30th, they'll buy it on December 29th, then 28th, then 27th, then December 15th, then Thanksgiving, then Halloween, and they'll start. And so the opportunity to buy at one time and sell at another time, if there's any strategy, it gets out in the marketplace, people take advantage of it, and ensure that strategy will not beat the market in the future. Okay. Some strategies do beat the market, and somebody will say, I got a market-beating strategy, but that strategy doesn't work on a risk-adjusted basis. A simple way of beating it would be to say that okay, the stock market goes up over time. Okay, it goes up on average 10%, and over time it goes up. So Andrew is he's going to buy the S&P 500, and he's going to take $10,000 and buy the S&P 500. My strategy is going to be, well, I'm going to buy it levered. I'm going to buy twice as much. Well, the odds are that you go back and if you do a study on those two strategies, I'm going to make more money than him. I'm going to make about twice as much as him, but I've taken twice as much risk. Another example would be the example that Burt Malkiel talked about, where a strategy that Eugene Fama and Ken French came up with. And by the way, if people that I think are great people to follow, other than myself, in investment, giving investment value and giving investment advice, one is Burt Malkiel. You're reading his book. The second is Fama and French. And by the way, French's sister is Carol Dukeman, who lives over on Thornwood Avenue in Hunter. Okay, so Fama and French, and the third person is who's my buddy over at Jeremy Siegel from University of Pennsylvania. And all those guys are pretty bright. And this is a business where there's charlatans. There's thousands and thousands of brokers out there that tell you that they can beat the market and that you should give them, your money, and that they will beat the market. And you know what? 99.999% of them can't. Most people cannot beat just buying a market index. If I had to pick out a couple of people that if anybody could do it, I would pick the people that I just mentioned, Fama and French, who are a team, and Jeremy Siegel. Now, what are these guys doing? Well, one of Fama and French's ideas is that you buy out of favor stocks, that you buy stocks that have grossly underperformed the market for 3 years, and that if you constantly roll into a broad cross section of stocks that have underperform the market, they beat the market. Now, could say that, okay, you back tested it, it works, maybe it'll work in the future, but doesn't it make sense that by buying stocks that have grossly underperformed the market for 3 years, aren't you buying stocks that are riskier? And isn't, we just made the simple case that if you take more risk, you earn more return. And one way to earn more return over the long run is just to lever yourself up and use $10,000 to buy $20,000 worth of stock. Another way to make more return is to buy an investment of riskier stocks. And doesn't it seem like a reasonable argument that that you're constantly going to be buying stocks that have gone down for 3 years relative to the average? So are strategies like that, are they really beating the market, or are they really just taking on more risk? Or do those strategies beat the market once you adjust that strategy to the amount of risk that you have to take to get it? For the case of me and Andrew, $10,000 worth of stock, 10,000 and borrow 10,000, it's clear I'm taking more risk. With some of these other strategies, it's not clear. Okay. Any questions on what I've said? Any questions on any of the reading of this week? This is kind of an overview isn't this kind of an overview of what you read? Okay. Catherine.
I just have a question.
And always speak up so good. We're recording this this is gonna be watched on the internet decades from now.
With the efficient market hypothesis, the strong one, why then is insider trading still illegal? Is it just because it's a hypothesis?
That is a great question. And academics say that insider trading shouldn't be illegal. You should let people do whatever they want to do. And I mean, really, and not crank academics. Some academics say, hey, that shouldn't be a crime. Just let people do whatever they want to do. Some people say some academics say that trading on insider information actually makes the market more efficient. Let everybody trade on it all the time so that you'll even be more confident that the price of the stock is efficient. So, but great question. Any other questions on what you read? Okay. Homework assignment. I want everybody to have one good question next week. On anything that we've talked about in this seminar. Not whether the Bears are going to win the Super Bowl. Okay, Jeffrey.
All right. I was hoping for an answer for that.
Okay, let's move on. Okay, what do I think? I think the market's pretty darn efficient. I think that I think it's efficient. I don't think that the strong form is kind of pushing it a bit, but there's so many people, so many smart people that devote their lives to pricing these securities that I think it's pretty efficient. And I say that with enough conviction that I'd say my advice to you on investing is not to try to beat the market, except under certain circumstances, and we'll get that later. But if you don't go into this business, what's so funny, Elizabeth? What?
Nothing.
I think the market's efficient. I think the best thing you can do for your personal investing is to buy something close to the world portfolio and use index funds as much as you can, and the dollar cost average, and to keep your fees low. Most people that charge you fees, whether they're mutual funds or whether they're mutual funds or hedge funds, they don't deserve the fees that they're earning, and that by paying those fees, you are just you're reducing. You're most likely reducing the terminal value that you're going to have for your portfolio. Diversification is very important. You shouldn't just buy one stock. You should use funds that are tax efficient and fee efficient in order to get diversification across a broad array of securities. And the biggest decision you have to make is what is the proper percentage of your investments to have in equities, in the major asset classes, which are equities, investment grade bonds, high-yield bonds, real estate, collectibles, that you determine what those percentages are, and that you get money invested in the percentages that you decide are right for you, using index funds as much as possible, that are tax efficient, and that don't charge you many fees. That's what I think about the stock market. Now, how about the real estate market? Who here thinks the real estate market, the market for individual houses, apartment buildings, who thinks it's efficient?
I'll raise my hand for you, so you have somebody to argue against.
Okay. I don't think it's efficient. I don't think it's always. I think it's much less. Sometimes it's efficient. In general, it's efficient, but the market price of any one piece of real estate has a much higher chance of being improperly priced than the price of any stock or mutual fund or instrument that you can buy or sell at Schwab. Now, the reason is that take the price of IBM. Anybody in the world can get information on IBM. And there's plenty of people that don't do anything except study IBM or IBM and similar companies. And so the price of IBM reflects what thousands of really smart people that do nothing but study that stock and have billions of dollars behind them. The price of IBM is that it's trading at any point in time reflects the opinion of those smart people backed up by billions. And so for me to step in and say that I can say that IBM really should outperform the market by 10%, it's like, ugh. I have a difficult time having a large degree of confidence in that. But in real estate, well, say there's a building, say this building's for sale, which it is. Well, how many people are even going to know that this building's for sale? How many people are going to how many people are going to pour over the rents and the expenses and the view of the surrounding economy and blah, 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 everything that goes into deciding what to pay for this building? Well, certainly not as many people that are looking at IBM. So given that any one piece of property often doesn't have that many people with the means of buying that property, real estate, any one piece of real estate doesn't have the same amount of people analyzing the value of that as not as many people are analyzing individual pieces of real estate the way people are evaluating individual stocks. Now, if you look at real estate in general, real estate, one type of building in the whole United States, I'd say that, hey, that's pretty efficient. Okay. All your fathers, except for Charlie's, are involved in making money in the markets. So how can your fathers make money if the market is efficient? And I think it's pretty efficient. Okay, one, you got the bid-ask spread. When you go to buy a stock or any commodity, most of the time you're giving up the bid-ask spread. Your fathers are often, not always, but they're often earning the bid-ask spread. That difference between being able to buy something at 12 and sell it at 13, or buy it at 12 when you want to buy it and sell it at 13 when you want to sell it. The difference between being able to buy at the bid and sell at the offer just part of the time over the course of a career definitely can make the difference between beating the market and not beating the market. Um, a classic, let's put it a simple way. Let's say that I want to buy IBM, so I buy 100 shares, and or I want to buy the 5-year note, something you girls have traded. I want to buy the 5-year note, so I just go buy it. But what you girls do is you say, okay, I want to buy it, and it's 12.13, and you buy it at 12, and then it goes down. One, I bought it at 13, but you're buying the bid-ask spread, and so you buy one, and I buy one, and I buy it at 13, you buy it at 12. Now let's say the market goes 11 bid at 12. Well, you still want to be long one, I want to be long one, so I'm still long it. But what you do is the market's 11 bid at 12, you sell the one out that you bought at 12, you sell it at 12, and then you buy it at 11. So you're at a break even. I'm down 2 ticks. The market keeps going down, and you keep buying the bid-ask spread all day long, okay? And it keeps going down, 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 and it goes down the next day, and it goes down the next day. So I'm down 100 ticks after 3 days, okay? And I'm down $3,125, Brian? And I'm down $3,125. But all the way down, you bought one. Every time the market went offered, you sold one on the offer and bought it back on the bid. The whole time you've been long. But it's now down 100 ticks, and what are you? You're at a break even. Because every time it went down, you sold the offer and you bought the bid. And I'm down $3,125. You guys are at a break even. And then the market comes back up to where we trade it, and I get out at a scratch. And I say, I sell it out at 13. I say, okay, well, I broke even on that trade. And you decide at the same time that you don't like the trade anymore, and you sell out. But you're long at 100 ticks lower. So you made $3,125 on your one lot. And what did I do? I broke even. So that bid-ask spread is very powerful, and not easily. If you can buy the bid and sell the offer whenever you want, that makes a huge difference and can allow you to beat the market.
Do you guys understand?
Let's jump ahead to. Okay, go ahead.
Well, I just want to make sure that do you guys understand how? Do you understand the example? How if you're buying on the bid, selling on the offer, even though the market's going down, you're not actually losing money on the trade. Is that everybody gets that?
Okay. Before we go to commissions, let's jump ahead to the third point there. And I don't know if we're going to get to it today. Maybe we will. But you had that simulator where you were trading, 5-year, 2-year notes, 5-year notes, and E-minis. The guaranteed strategy for making money on that simulated trading would be to do what I just said. That simulator gives you the edge either all the time or half the time, meaning when it trades on the bid, you buy one. When it trades on the offer, you sell one. Well, if you went back and tried the strategy of bidding the bid and offering the offer when the amounts were large, and then when you, if you bought on the bid and then the bid became really small and you got out, and if you missed, if the market turned and you bought it at 12 and it went 12 offered, and you weren't able to sell it, but you immediately got your offer in to sell there at 12, and well, most of the time you're going to get the edge. You're going to be able to buy on the bid or sell on the offer a lot more than any of us will because of the way that game is, because of the way that the simulator's set up. Well, if you did that, if you sat here, it might not work for the first day, but if you sat here day after day after day and you worked on that simulator and you got the edge every time it traded on the bid or the offer, or even if you bought on the bid and sold on the offer half the time that it traded on the bid, traded on the offer, you would make money. And I think that would be an interesting thing to try, and we're going to have Jeffrey try that between now and next week if we don't start it today. And I feel comfortable. If you girls want to trade on and guys want to trade on that simulator, you can, and you can do it from home. Okay, and I think let's make that a homework assignment too, to try to do that. Can you have Charlie do that with you, Abby?
Wait, I can't do that.
Okay, you can do it with Jane.
All right.
Okay, and Catherine, you got it on yours. Jeffrey, you do it in the office. That's it. Okay, homework assignment for next week. One is one good question, and two, I want you guys to spend a little bit of time on that and let us know how you did. Okay, going back to bid-ask spread. Sometimes you can earn the bid-ask spread by lifting the offer. And say, how do you do that? Well, pretty difficult, but that's there are some people there's some people that develop models, and these are one of the mathematical models that works. Some people will develop mathematical models which will which will look at, say, the 5-year note that you're trading, and it will look at the price of the 5-year note, and the price of the 2-year note, and the price of the 10-year note, and the price of the 2-year cash, and the 5-year cash, and the 10-year cash, and the price of all sorts of other closely related instruments. And it will develop a model to say how often and how big is the lag for the 5-year to go up after the 2-year goes up or the 10-year goes up. And it will also look at volume data, in other words, the size of the bid, the size of the offer, the size of the trade, not only in the 5-year note, but the 2-year note, the 10-year note, the 2-year cash, 5-year cash, 10-year cash, euros, and all sorts of other things. And we'll develop this model, and it will, and so it will be a model that will predict based on the trades and other instruments, the bids and other instruments, the offers and other instruments, the prices, the amounts of the bids and the offers, the size of the trades and the other related instruments, and will simultaneously gather information from all these different markets, and we'll feed it into a model, and then we'll tell and it will the mathematical model will predict. Well, given all these things, where the model is getting a constant feed of all this information, the model will say, okay, this now has a 90% chance. This 2-year now has a 90% chance of trading up, and then the computer, even without human intervention, will go ahead and will buy the 2-year or buy the 5-year, whatever it said should be bought, and then it will look at that position, and that same model will say when they should get out of that particular instrument. And so that program is essentially doing the strategy that I gave you as a guaranteed strategy for trading on your simulator. But rather than you just doing it with your head, just looking at one instrument, the 5-year, it's using price and size data instantaneously from a variety of sources, and giving instantaneous orders. And sometimes, sometimes what that basically is doing is predicting, well, when is the ask going to become the bid, or when is the bid going to become the ask? And so it will step up and lift an offer by the ask, and a very high percentage of the time, the ask becomes the bid. For really good traders, like Brian and Danny, they kind of do that. That's kind of what goes through their mind when they're deciding, certainly when they initiate a trade where they buy the higher price or sell the lower price. All that stuff's going through their mind, and they're not just paying away the bid-ask spread the way some doctor would in Beverly Hills, or the way you would if you put your bid in and then you went out to play golf or do whatever you're going to do. They would, and you would wind up buying the bid when the bid became the offer. But there are mathematical models or even processes can go on in traders' minds that allows them to predict with a much greater than 50-50 odds when the bid-ask spread is going to change. Okay, commissions. Most strategies that you're going to do in investing, hey, they're going to involve commissions. They're going to involve bid-ask spreads. Those commissions can really rack up. They can, for active strategies, they can rack up into. We had an active stock trading strategy, and we made $250,000. We made $100,000 one year, and we spent $400,000 in commissions, and still marginally successful. But the difference between your dads pay very low, negligible, almost zero commissions, and the difference between paying a commission and not paying a commission can be the difference between making or not making money. An example, I used to be, well, actually, I'll combine it with speed. Okay? Go to speed, and then I'll take it back here. Your dads, sometimes here, and certainly in the pits, were faster than all other investors were. Let's just take a look at this commission and speed. Let's say we used to have a strategy where we stood in the pit and we found a correlation between a spread where you could, at certain levels, you could buy SEP, sell Ds, and buy 5 extra SEP, and that at certain levels, that package of 100 SEP, buying 100 SEP, selling 100 Ds, or buying 105 September and selling 100 December, that buying that traded in a band, and that we could buy it in the lower band and sell it in the upper band. And we did a lot, and we made money. You say, well, geez, you said the market's efficient. How could you do that? Well, one of the reasons that we could do that is our commissions for buying 105 SEP and selling 105 Ds were a nickel, 10 cents, 20 cents round turn, 20 per contract. It was 20 cents. It was 40 cents per spread. And other people on the outside were paying $15. So there were two things that happened. One, everybody knew that this thing oscillated, that it was down here, you wanted to buy it, and it's up here, you wanted to sell it. Well, part of the trade was to buy 5 outrights. So as the outrights were moving up and down, they'd move down and say, okay, now I want to buy the 5 outrights and buy the spread. And we knew that the market went down 30 seconds before the people on the outside did. So one, we knew that it was at the trough and was buy before people on the outside did. We had a speed advantage. And the other thing is, we paid 40 cents multiplied by 100. For a 100 lot, we paid, to buy 105 and sell 100, we paid $40 to buy and sell 105 SEP and buy and sell 100 Ds. People on the outside were paying $15
per contract.
So, per 15, which is $1,500
$1,500
for the whole package. Oh, why does she always bother us? What? What? I'm at 38. Hey, I don't want cotton.
You want to take over teaching right now?
Yeah.
You can see the blue pair I got. I don't want cotton doctors. I don't want doctors. I want things to keep grease. And I'm in the middle class here. 38. 38. Okay? Okay, so one, we were faster than these other guys, and when the trade got to the trough, because the outright came down and we could buy the 5 lots at a low enough price, well, we were buying it before they did. And so when they came in, we bought the 5 outrights, and then we bought the 100 spreads, and the trade wouldn't even be there when they came in. And the second thing is it cost us, what did I say it was?
$40.
$40 to buy and sell 100 spreads, and it cost them $1,500. So let's say we did this strategy, and on 100 of it, on 50 of it, we made a tick, and on 50 of it, we broke even, so that we made on average half a tick. Well, half a tick was $1,500, $1,562, and we made $1,562 minus our $40 in commissions. We made $1,522. And what did they make? Well, they did the exact same trade if they could have gotten it, which often they couldn't because we were faster, and then they paid $1,500 in commission. So, let's see. We did a trade, we made $1,522. They did the same trade, and they made $62. And so they wouldn't even try to do that trade. They wouldn't try to do that trade where they'd make a half a tick because of their commissions and their speed. It just wouldn't be economic. And a lot of people, a lot of your dads have been able to make money over long periods of time, and it's not contradictory of the efficient market hypothesis. They were able to do it because they had the bid-ask spread. They had no commissions, essentially. They had more speed. Okay. Another thing, another reason some of your dads, it's us mainly, why we can make money is we have complicated strategies that are virtually impossible for people outside the market to do, and even for people inside the market, even for professionals. The strategies are complicated enough and have required us gathering information over many years and more than getting into the decades that they're just too complicated and require too much detailed information. I'll go over one of those in a little bit. Okay, for market makers, it's not unusual for market makers to make a 20% to 200% return on their capital. That's if they are earning the bid-ask spread. Return to long-term investors. Well, hey, you know what? We just figured out that the S&P returns 10.6 over time. Most people don't beat the S&P, so most long-term investors, if they're making 10%, they're doing just great. Most people don't do that. When a market maker gets involved in a field that is where there's good opportunity, hey, 200% return on capital is possible. If you looked at the specialists on the New York Stock Exchange, when every order went through the New York Stock Exchange, it was handled by a specialist, and when he had the right to buy any order on the bid or sell it on the offer before anybody else did. Those guys made 80% on their capital, and they were pretty big operations. There was when options on futures first came to. Remember what an option is? A call. A call option is the right but not the obligation to buy something, a commodity or a stock. A put option is the right but not the obligation to sell something, a stock or something else. When options on commodities first made legal in recent history, in modern day history, in the early 1980s. And there was a firm, CRT, Chicago Research and Trading, that made 200%, over 200% on the capital for many years. They wound up doing that for a bunch of years. Their capital kept getting bigger. They kept making 200%, and they sold their whole operation, lock, stock, and barrel, for hundreds of millions of dollars to a big bank that eventually became part of Bank of America. Okay, well, it's not that easy to just earn 200%. Because what happened to Chicago Research and Trading? Options came around, and Chicago Research and Trading came up with a a method, came up with a way of trading options. They came up with a way of earning the bid-ask spread and earning these fantastic sums on their money. And even though they really tried to, they didn't go out there and share that information with anybody. They weren't in the business of giving it away. They didn't write articles about it in the newspaper or in academic journals. They wanted to keep it to themselves. But other traders saw what these guys were doing, and other smart people were able to piece things together and figure out what they were doing. And they said, well, I want to make that kind of money. And so more people went into the business. More people were able to watch what they were doing, figure it out. And so you don't keep making even as a market maker, you don't keep making money like that over long periods of time. More competition comes into the field, and the rates of return drop. In the case of the specialists that were making 80% on their money back in the 80s, 80s and 90s, a lot of people didn't like the idea of giving all this money to the specialists, so they came up with alternative ways of trading stocks. They came up with ways of trading it off exchange, and of course the New York Stock Exchange to change how they did business, and rates of return dropped. So much so that those firms that were making 80% on their money are now going out of business. Turnover among floor traders. Floor traders, hey, they make the bid-ask spread a lot. A lot of people have made a lot of money over time, but you don't just get that. Even though, I sat down and gave you the theory here for how a scalper can make money and how you can use the bid-ask spread to, I think, make money on the simulator, and how if you're getting the bid-ask spread, you can definitely make money. Well, you don't become rich just by showing up, because even when the trade stayed on the floor for decades and decades and decades, hey, there's competition, and the theory is pretty simple to lay out. I laid it out here for you in a few minutes, but more people come in that do various things to compete for that bid-ask spread, and bottom line, even when the trade was all on the floor, the turnover among traders was pretty high. The turnover in the bomb pit, there were like 700 people in the bomb pit. Hey, Brian, you think 30 people a month would roll in and out of the bomb pit in the heyday in the 80s and 90s?
Yeah, that's probably pretty low.
Okay, Brian was in there for years, decades. So it's like 700 people, but 30 people are coming and going every month. And in the bond spread area where we were, there was 100 people down there that were making a living. And then they changed the tick size, the size of the bid ask, from $31.25 into a quarter of a tick, or $7 and some cents. And the number of people that were able to make a living with the smaller tick size, it dropped from 100 down to 25. So anyhow, even with all these things that are going your way, bid-ask spread, commissions, speed, complicated strategies, there's still turnover. Since a lot of the financial trade moved to computers in around the late 1990, from 1999 to 2000, right in around that area. Since then, there's been two generations of turnover. In other words, the first people that started to trade, that became successful trading on a computer, they were young kids came in, they got the knack of it. There were hundreds of people making hundreds of thousands of bucks a year. And then the sophistication and then there became a new generation of programs which traded on these computerized systems, and 80% of the first generation of computer traders were knocked out of the business and sent off to do other things. So the market is generally efficient, but if you have a bid-ask spread, and you have low commissions, and you have speed, and you have complicated strategies, and you are able to adapt, even in spite of having all those things. It's a very competitive field. Anybody can get into it. That has all they need is the backing of. Here, we're about to put Jeffrey into it. He knew less than you girls know right now, right or wrong. Jeffrey knew less than you did. When did you show up? 2 months ago, and he's going to be trading for us here, before another month has gone by. He's not putting up any of his own money. If he does well at that, we'll cut him a percentage deal, or he could wind up leaving us, and taking his own money, and boom, he's in business. It can happen that quickly. But because of that, there's a constant flow of new talent to this pool, and that means to continue to beat the market, you need some of these things as a prerequisite. And one thing that you constantly have to be doing is you constantly have to be getting better at what you do. And so your dad's been in this business a long time, and to survive that Darwinian struggle of the survival of the fittest, it's been they've done well. Okay. Who's the best? Not us. But we have the most fun. I think the best is, it's tough to tell. But there's this firm called Renaissance. Just to talk about what you're up against. What is your competition when you're trying to make money in either a long-term strategy of beating the market, which I said is a pretty tough thing to do, or a short-term strategy that involves some sort of market maker advantages. Well, there's this firm out in Long Island, started by this guy Jim Simons, and this guy was one of the most brilliant mathematicians in the country. He invented a theorem. He has his own theorem named after him, the Simons theorem in geometry. He's up there with Pythagoras, all these guys, and extremely smart guy. He used to work for the Institute for Defense Analysis, where he cracked uncrackable codes. And he decided to get into the trade. He was head of the math department at State University of New York at Stony Brook. And he said, well, geez, I think I can beat the market. And he read the Malkiel book, and he said, I think I can beat it. And so he applied his mathematical skills, and he brought more and more mathematicians in. And right now, 25 years later, they're probably the preeminent trading firm in the world. They have 60 PhDs in stuff like computer science, math, physics, computational chemistry. But these aren't just PhDs. This guy has ins since he. This guy has ins at the best universities, the best PhD programs in the country, and he has his fingers into a lot of them. And whenever a truly brilliant guy that is just smarter, you got to be really smart to be a PhD candidate in math or physics at MIT, right, or Caltech. Well, for the best of the best of the best of the truly brilliant that are just, where the average IQ is 100 and 140 is kind of like almost genius level, and 150 is clearly genius. But there's some of these guys just so bright that you can't even, there's no way to measure how bright they are. Well, what happens to them is of the brightest of the brightest of the bright. They're sitting there in their little cubicle, and they're hoping that when they finish this dissertation, they're going to get a job maybe as an assistant math professor at Harvard, because Harvard's a great school, or MIT, and they've they've made their application, they've just finished their thesis, or they're about to finish, and they're filling out a job application, and the door knocks. And in walks Jim Simons. Jim says, "Hello, Andrew. My name is Jim Simons."
Hello.
And the guy would say, "Oh, with the Simons theory?" Of course. And Jim Simons will say, "I have a deal to make." I says, "What's the deal?" He says, "Well, I want you to work for me." I said, "Well, that's interesting, but I just applied to Harvard as an assistant professor. They've indicated that they're very interested in me, and so let me wait till I hear from Harvard. Or maybe they already have the job from Harvard. Harvard is going to pay that guy, I don't know, maybe $50,000 a year. It's assistant prof, maybe 75. Give him housing. Only has to teach a couple courses, and work on writing a book, becoming famous, and maybe you'll get, tenure at a big university, and make $250,000 a year." Simon says, "Well, no, you're going to come to work for me." And so Andrew says, "Well, what is it that you can offer me?" And Simon says, "I'm going to pay you $3 million a year for the next 5 years to work on a project. And you'll get that money even if you don't do anything, even if you don't generate one penny. But if you do generate, if you are helpful on this project that I think might be successful after 5 years of effort, and you're going to work on this with 5 other of the brightest people in the world. And if you're successful, you will take all that money, you'll reinvest it in the fund, and oh, by the way, in our fund, you won't pay commissions. And our fund is earned no less than 30%. Our average return has been 35% over the next 15 years. And you'll keep whatever you want out of that $3 million a year. But I'd suggest you put half of it or 2/3 of it into the fund." We talked about compound interest. Imagine 35%. That's the number. And the guy says, "Well, how's the guy doing that you hired 10 years ago for this position?" "Well, he's worth $150 million. He's the guy that I hired out of this office 5 years ago." And so most of these guys, when they get called, that's where they go. And that's kind of a brain drain for the brightest people in the world in computer science, math, physics, blah, 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 blah. And, those guys they're certainly beating the market. They're making those kinds of returns. They've made them for 20 years. It's kind of like, hey, they're the best. That's kind of what the competition is. And, okay. Is that it? Is that the end of it?
I think so. Yeah.
Okay. Now, let's take a look. We're going to now swing over to my desk, and I think at this point we're going to show one of our trading strategies, and this is going to be difficult to. This is going to be difficult to for people that are listening to this remotely, and so we will end the
Recording.
recording.
Did you guys get everything down from that slide that you wanted?
Any questions? You think that kind of went over what Bert Malfield talked about?